Hey there, economic thrill seekers. Welcome back to Boss Economics World, your go-to channel for decoding the wild, wacky, and often downright absurd world of global finance. I'm your host, Boss, here to serve up some spicy economic commentary with a side of satire. Today, we're diving headfirst into the European Central Bank's, ECB, latest rate-setting circus, meeting, set for Thursday, July 24, 2025. But hold your horses, folks, because this isn't just about interest rates. Oh no, this is a full-blown economic soap opera, starring Donald Trump's tariff tantrums, a Eurozone on life support, and a central bank that's basically saying, we're done cutting rates, maybe, unless, well, let's see the data first. So, grab your popcorn, or your financial spreadsheets if you're one of those fancy finance pros, and let's break down this mess. We'll dig into the juiciest data, expose the economic logic, or lack thereof, and predict where this roller coaster is headed. Spoiler alert, it's not looking pretty, but hey, at least it's entertaining. Let's set the scene. The ECB is gearing up for its big meeting this Thursday, and the word on the street, or rather, the corridors of Frankfurt, is that they're hitting the pause button on rate cuts for the first time in a year. After 8 quarter-point cuts that dragged the deposit rate down to a cozy 2%, ECB President Christine Lagarde is basically saying, we're good, fam, borrowing costs are now neutral, not too hot, not too cold, just right. Neutral, huh? Sounds like the ECB is trying to Goldilocks its way out of this economic mess. But here's the kicker. While the ECB is busy patting itself on the back, the Eurozone economy is looking more like a patient on life support than a sprightly recovery story. And guess who's holding the defibrillator? That's right, Donald Trump, with his tariff threats that are more unpredictable than a reality TV plot twist. Add in geopolitical turmoil, a euro that's stronger than it has any right to be, and a business sector that's basically saying, help, we're drowning in fees and uncertainty. And you've got a recipe for economic chaos. So, what's the ECB really up to? Are they genuinely confident, or is this pause just a case of stage fright, waiting for the data to tell them whether to cut, hold, or run screaming into the night? Let's dig into the numbers and find out. To understand the ECB's next move, we need to look at the avalanche of economic reports hitting the wires this week. These aren't just boring spreadsheets, folks, these are the tea leaves the ECB is desperately trying to read to figure out if the Eurozone is holding up or falling apart. Let's break down the key data points and what they mean. First up, we've got the ECB's quarterly bank lending survey, dropping on Tuesday, July 22, 2025. This is a biggie because it tells us how the ECB's rate cuts are actually trickling down, or not, into the real economy. Remember, the ECB has been slashing rates to make borrowing cheaper, hoping to juice up demand for loans, especially mortgages. And according to ECB Executive Board member Isabel Schnabel, the last survey showed a stimulative effect, lower borrowing costs were indeed boosting mortgage demand. Hooray, right? Not so fast. Here's where things get messy. Since the last survey, Trump unveiled his latest tariff threats in April 2025, promising levies of up to 30% on European goods. That's not just a trade spat, that's an economic earthquake. Banks, already jittery about geopolitical risks, have been tightening credit standards, making it harder for businesses and households to borrow. The latest ECB survey of firms, published on Monday, July 21, 2025, paints a grim picture. Companies are reporting higher costs for fees, commissions, and collateral requirements. Translation: even with lower interest rates, borrowing is getting more expensive, not less. So, what's the latest survey likely to show? According to HSBC economist Fabio Balboni, it'll reveal how Trump's tariffs and geopolitical uncertainty are gumming up the works of ECB policy. If credit conditions have improved despite all this chaos, it might bolster Schnabel's case that the ECB's work is done, no more rate cuts needed. But if the data shows a credit crunch, it could force the ECB to keep the door open for more easing. My money's on the latter, folks, because let's face it, when has Trump ever made life easier for anyone? Next, we've got the S&P Global Purchasing Managers Index, PMI, on Thursday, July 24, 2025, and Germany's Ifo Business Confidence Indicator on Friday, July 25, 2025. These are the crystal balls of the business world, giving us a sneak peek into how companies are feeling about the future. Here's the backstory. The Eurozone economy started 2025 with a bang, thanks to a front-loading of U.S. orders as businesses rushed to beat Trump's tariffs. GDP growth in Q1 2025 clocked in at a surprisingly robust 0.8% quarter-on-quarter, according to Eurostat, way above the ECB's forecast of 0.4%. But don't pop the champagne just yet. ECB Vice President Luis de Guindos has already warned that growth will be almost flat in Q2 and Q3 2025 as the front-loading effect fades. And the latest data backs him up. The Eurozone composite PMI fell to 50.1 in June 2025, barely above the 50 mark that separates growth from contraction. Germany, the Eurozone's economic engine, is looking particularly wobbly. The Ifo Business Confidence Index dropped to 87.0 in June 2025, its lowest level since the pandemic, as manufacturers grappled with higher costs and weaker export demand. And here's the kicker, the euro has appreciated by 5% against the dollar in 2025, thanks to the ECB's relatively hawkish stance compared to the Fed's dovish pivot. A stronger euro might sound great for your summer vacation in New York, but it's a disaster for European exporters, making their goods more expensive on the global market. So, what will this week's PMI and Ifo data show? If they come in soft, it'll be a flashing red warning sign that the Eurozone is sliding toward stagnation, or worse, recession. And that could force the ECB to rethink its pause strategy faster than you can say, Trump tariffs. Finally, let's talk inflation, or the lack thereof. The ECB's latest survey of firms shows that companies expect inflation to be just 2.5% 1 year from now, down from 2.9% in the previous survey. Over 3 and 5 years, they see prices rising at 3%. That might sound like good news, hey, inflation's under control, right? But for the ECB, it's a nightmare. Why? Because the ECB's target is 2%, and if inflation expectations keep drifting downward, it raises the specter of deflation, where prices fall, businesses cut wages, and the economy spirals into a black hole. And here's the scary part, the ECB's own projections, released in June 2025, show inflation dropping to just 1.6% in 2026, only returning to the 2% target in 2027. That's assuming a benign trade outcome, i.e., Trump doesn't slap 30% tariffs on everything European. If those tariffs hit, inflation could fall even further as demand collapses, forcing the ECB into a corner, cut rates more, or risk a deflationary spiral. Fun times, huh? Now that we've got the data, let's zoom out and look at the bigger picture. Why is the ECB in such a pickle? It all comes down to 3 interlocking problems: external shocks, internal weakness, and policy paralysis. First, let's talk about the elephant in the room, or rather, the orange-haired billionaire in the White House. Trump's tariff threats are the economic equivalent of a wrecking ball, smashing through the Eurozone's fragile recovery. According to the European Commission, a 30% US tariff on European goods could shave 0.5% off Eurozone GDP in 2026, with Germany and Italy hit hardest. And it's not just tariffs, geopolitical turmoil, from the war in Ukraine to tensions in the South China Sea, is driving up energy and commodity prices, squeezing businesses and households alike. Second, the Eurozone economy is weaker than a house of cards in a windstorm. Sure, Q1 2025 looked good, but that was a mirage, fueled by front-loading. Strip that out, and growth is anemic at best. Unemployment in the Eurozone is stuck at 6.5%, according to Eurostat, with youth unemployment in countries like Spain and Italy still above 20%. And don't forget the euro's appreciation, which is hammering exporters and pulling inflation lower. Silke Tober from Germany's IMK Economic Research Institute sums it up nicely: the ECB's rate cuts so far aren't sufficient to counter economic weakness, especially with the euro acting like a straitjacket on competitiveness. And third, the ECB is stuck in a classic Hamlet moment: to cut or not to cut, that is the question. On one hand, hawks like Isabel Schnabel argue that the economy is resilient, and the bar for further rate cuts is very high. On the other hand, doves like Bank of France Governor François Villeroy de Galhau are sounding the alarm about growth headwinds and the risk of inflation undershooting 2% for years. The result? A central bank that's paralyzed, waiting for the data to tell it what to do, while the economy teeters on the edge. So, where does this leave us? Let's play fortune teller and sketch out 3 possible scenarios for the Eurozone, and the ECB's next move. In the best-case scenario, Trump's tariff threats turn out to be more bark than bite, and the Eurozone muddles through with modest growth. The PMI and Ifo data this week show green shoots, as BNP Paribas economist Paul Hollingsworth puts it, and higher public spending in Germany and France offsets the trade uncertainty. Inflation stabilizes around 2%, and the ECB sticks to its pause, maybe even hinting at rate hikes in 2026. Probability? I'd give it 20%, because let's be real, when has the world ever been this kind to Europe? In the most likely scenario, the Eurozone slips into stagnation. The PMI and Ifo data come in soft, confirming that the front-loading effect has faded and Trump's tariffs are biting. Growth flatlines at 0.1% quarter-on-quarter in Q2 and Q3 2025, and inflation drifts down to 1.5% in 2026. The ECB is forced to cut rates again, maybe by 25 basis points in September 2025, but it's too little, too late to spark a real recovery. Probability? I'd say 60%, because this is Europe, where muddling through is practically an art form. In the worst-case scenario, Trump slaps on 30% tariffs, geopolitical tensions spiral, and the Eurozone plunges into recession. GDP contracts by 0.5% in 2026, unemployment spikes, and inflation falls below 1%, raising the ghost of deflation. The ECB panics, slashing rates to zero and dusting off its quantitative easing playbook. Probability? Let's call it 20%, but if Trump's track record is any guide, don't bet against chaos. Alright, folks, let's wrap this up with some boss-style straight talk. The ECB's rate pause drama is just the tip of the iceberg. Beneath the surface, the Eurozone is a house of cards, propped up by wishful thinking and duct tape. Trump's tariffs, geopolitical chaos, and a stronger euro are external shocks Europe can't control. Anemic growth, high unemployment, and policy paralysis are internal weaknesses Europe can't fix. And the ECB? It's stuck playing whack-a-mole, reacting to crises instead of preventing them. For you finance pros out there, here's the actionable takeaway: short the euro, hedge against trade risks, and keep an eye on those PMI and Ifo numbers. They'll tell you more about the ECB's next move than Lagarde's press conferences ever will. And for you everyday viewers, here's the bottom line: Europe's economy is a mess, and it's going to get messier before it gets better. So, buckle up, because this ride is about to get bumpy. That's all for today, folks. If you enjoyed this economic roller coaster, smash that like button, subscribe, and ring the bell for more Boss Economics world goodness. Got a hot take on the ECB or Trump's tariffs? Drop it in the comments. I read them all, even the crazy ones. Until next time, stay savvy, stay skeptical, and keep laughing at the absurdity of it all. Boss out.